this might not be a 2026 story, but I think over the next 3 years, robotics is going to have a bit of a ChatGPT type of moment where all of a sudden the idea of having usable, helpful robots in your home, whatever it is, doesn't have to be humanoid, but just helpful robots. Is going to start to proliferate. It's already, I mean, the humanoids are already becoming somewhat affordable for a kind of beta type of leading edge type of technology, so that's sort of
Yeah.
changed. I think AI itself has really solved a lot of problems for robots in terms of how they reason with their environment and their physical environments. And I think you also have a lot of pull forward with the data center build out as well.
All opinions expressed by Chris, Michael, and Ryan are solely their own opinions and do not reflect the opinions of 5i Research or i2i Capital Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Employees of 5i Research may hold positions in the securities discussed in this podcast.
Welcome to the 20th episode of The Exponent with 5i Research. My name is Chris. I'm the head of research with 5i, and I want to welcome you, our listeners, to our journey into the heart of the Canadian markets. Our mission is to empower investors with precise insights and in-depth research into stocks, the economy, and more. With that said, let's dive into the Canadian and U.S. financial landscape. So today I'm joined by my co-host, Ryan. Welcome.
Always fun to be here.
Yeah, no, for sure. And it's been a while, and it's start of the new year, so figured we kind of go along with our usual kind of routine for what we talk about. So first, we're going to be doing market pulse, what's moving the tape. Then we're going to be looking at tweets of the week, some hot takes on the market, Dividend Radar, the 5i Q&A spotlight. I think you're going to be talking about some of the Supreme Court kind of tariff drama going on there. We've got the 5i AI report, a little bit of a deep dive on a stock, and then quick investor edge, where we kind of do a little investor education. So do you want to kick us off with the market pulse?
Yes, for sure. So in the first podcast for us for the year, and hopefully the first one where we have solved our audio issues. So we will see. Right. It always seems to be a problem every time now. So Thanks everybody for your patience. So this time around, it's almost hard to talk about the macro just because there's resolutions and tweets and whatever flying all over the place on the macro side. A lot of it seems to be just kind of noise. So I think the best approach on the macro, I mean, probably always on the macro side, is kind of just zoom out, don't react to whatever recent headline is coming, because oftentimes things are getting walked back or they just don't really amount to what maybe that the initial kind of fear is. Mm-hmm. And over the last month of January, that has been kind of the right move, right? Is to just sort of, I mean, ignore is probably not the right word, but just don't react to whatever macro headline, geopolitical headlines coming through. So we'll skip a lot of that stuff. And we're actually at the very front end of earnings. So we have a bit of kind of insight into what's going on in the economy at the consumer level, things like that. So banks are obviously really good bellwethers for just broad economic activity. And in the U.S., lo and behold, things actually look pretty good. There's no, maybe they're not, the bank earnings aren't roaring or anything like that, but they're certainly in line with expectations. Guidance is in line with expectations. A lot of commentary around the consumer looks, positive in the sense that the banks are sort of all across the board saying that, consumer looks good. We're not really seeing much to be concerned about, always kind of stay on your toes kind of thing. But really just the earnings are good, and the outlook is pretty optimistic from most of the U.S. banks at a high level. And then if you need, further confirmation about consumers being strong, look no further than airlines, right? The airlines are quite sensitive to general consumer health and economic activity. And airlines actually had pretty good quarters as well. And it's kind of similar to the banks, sort of in line outlooks, sort of in line, maybe a bit stronger than people were expecting, but just, good reports overall. And a lot of these companies are having record revenues. And one interesting thing too is some of the airlines were saying that their business lines of like corporations and business travel is actually looking stronger than maybe they were expected. So that might be kind of a nice early indicator in terms of business activity picking up and maybe probably just a good sign overall for the economy, at least from a supporting the economy type of perspective. At the individual company level, another kind of one of the main noteworthy companies. So as we are taping this, that's reported. Probably by the time this gets posted, all of the the Meg 7 whatever companies, whatever we're calling them now, those companies all have kind of reported. But the one that up to this point has reported is Netflix. Not really a bellwether for anything, but just an interesting company anyways. And they had a pretty good quarter as well. They had 325 million paid memberships in their quarter, which was a record for them. And they were saying they're planning to double their ad revenue in 2026 or by the end of 2026, which is kind of interesting as well. So shares were down, I think 5% after the report, but
it's been under pressure.
Yeah. And I think the real story on it is just the Warner Brothers acquisition. It's a pretty big acquisition, and it's probably gonna be one of those companies that people sort of just sit and wait to see how all that unfolds. And unfortunately, a lot of the data points to when a company does a really big acquisition, it just usually doesn't work out that well. The synergies maybe don't come out as expected. Maybe the cultures clash a little bit, or they just take on, they kind of ruin the balance sheet to a degree. They take on too much debt, and it just takes them a really long time to work from under that debt burden. And so it's always, whenever I see them, whenever I see those big acquisition announcements, they're so attractive. You want to kind of get involved because it just sounds it's like such a good deal, or so many good things with all the synergies are going to start happening. But time and again, typically the right approach is to just wait and avoid companies that are doing really big acquisitions, just because oftentimes they bite off more than they can chew. Hopefully Netflix is a bit of a different story here, but the probably the data is not on their side on this side of things.
Yeah, no, for sure. And it's interesting because it seems like with Netflix, like some of that's like kind of being priced in with this huge decline, but even still, it is a huge acquisition, and it could, disrupt their balance sheet strength for some time. And that could cause like even further pressure and pain. But that stock has been pretty under pressure. But
I think a lot of that is because of this acquisition concerns around the acquisition.
Yeah. And on airlines, that's it's interesting seeing the strength. And then I wanted to share one interesting thesis that I've heard for airlines recently that I thought was interesting. It's maybe a bit pie in the sky, but with all the deep fakes going on recently, someone made the bullish case for airlines long term, because then, to like verify who you're actually talking to is who you think it is, you have to really just meet in person.
Okay.
So like business travel, other things like that actually will require like, round tripping back to, 1900 sort of thing, when last century, when we actually had to, fly to see people instead of like Zoom everything. But
the handshake's back.
Yeah, that's
the
right.
value of the handshake. Yeah.
But yeah, some of these deep fakes are getting like really impressive now. So it is kind of getting a little bit real.
Yeah, it'll be scary.
Yeah. It's happened quick, but okay. No, it's a good summary. I like that. So next tweets of the week, I wanted to share just two tweets that I had here. So this is from Matt Chermanero. They call him Chart Kid Matt. And he kind of put up this chart overlaying the top panel is Mag 7 against the S&P 500, the SPY ETF. And then the bottom pane is the IWM, the Russell 2K divided by the SPY. And so in the top panel, we see that the Mag 7 is actually breaking down against S&P 500. And then IWM small caps are breaking out relative to the S&P 500. So he kind of makes the case for, maybe it's, this simple. Maybe we could truly just be seeing small cap breaking out and Mag 7 leadership kind of failing for a bit. And it is on a shorter time frame. It's, last 1 to 2 years. So, small, like shortish time frame. But still, I thought this was kind of interesting because we have seen this massive rotation into the start of the year where small caps are really breaking out. And that bottom chart is pretty nice because it is showing a small cap breakout relative to, I think, like the last 12 months, basically. So pretty nice.
And typically small caps in that first month of the year, they have a good kind of seasonal effect. So they outperformance isn't rare for them as well. So it'll be interesting to see if there's some staying power in that as well.
Right. Yeah. Yeah. That's a good point. Okay. Yeah. And okay, second tweet of the week. We have this is from Jesse Cohen, and he talks about the top IPOs expected in 2026. So I just wanted to quickly go through kind of the main list that he has here. So the first one, SpaceX. So that's, space exploration theme. So they run the global Starlink satellite broadband network. I think that's looking at about $1 trillion valuation when it finally IPOs. OpenAI, that's the leader behind ChatGPT and other generative AI models. That's also likely going to be around 1 trillion market cap when it comes out. ByteDance, this is China's tech titan, known for being the owner of TikTok. We have Anthropic. It's a fast-growing AI company and the developer of Claude. Listeners may have heard of Claude recently because of Claude Code. It's kind of breaking the internet recently. Stripe is a global payments and fintech infrastructure provider for e-commerce. Revolut, that's a European digital neobank, super app for banking, forex, investing. And then finally, Canva, that kind of optimizes graphic creation with AI tools. And so while none of these are guaranteed to IPO this year, I thought this was kind of an interesting list if we do get this, because a lot of these names are like the software side of AI, as well as just some really interesting themes as well with space exploration and things like that. So
yeah, I mean, a lot of them are going to be potentially quite large, and will be a really good test for the market appetite for them as well. So it'll be interesting to watch for sure. I mean, I'm interested to kind of pull back the onion a little bit on SpaceX just to see what's going on there.
Yeah, and I'm sure like a lot of people want to know about OpenAI's balance sheet, what's going on with the revenue, ability to service debt, things like that. So that'll be interesting too. Okay, cool. And then I'm going to remove that. And then I think you had a section on Dividend Radar.
Yeah. So lots of special dividends again. And I think everyone now knows that I'm not a huge fan. I don't dislike them necessarily, but not a huge fan of special dividends, but sometimes they make sense. So Group Dynamite has really had their lightning in a bottle moment here. The stock's doing fantastic. The company's doing really well as well. Ticker's GRGD. And they, with kind of the success they're having, they've announced a special dividend at $2.30. And now this is, since we haven't done this for a few months, that was announced in December, that special dividend. Evertz Technology, the ticker's ET, also announced a $1 special dividend and a 2.5% increase to their regular dividend. And they're fairly consistently pay a special dividend year in, year out kind of thing. So that's not necessarily new or unusual for that company. Total Energy raised their dividend by a nice chunk of 20%. And Tariff, which is an interesting company because they're a nice acquisitive company with a decent little growth rate. And a lot of their revenues, actually, about 60% of their revenues are in the US. So interesting little company there. But they raised their dividend by 14% recently as well.
Nice. Yeah, I like that. Yeah, TVK is a pretty solid name. And with a bit of a bounce in oil, maybe that could keep going here. But yeah, no, it's great. Yeah, Group Dynamite, kind of like the mini Aritzia right now. So it's kind of following in the footsteps of Aritzia so far. So
yeah. And I wonder how much of that a lot of their run is based on just good. They've been having really solid results and stuff. But I wonder if people are kind of maybe getting ahead of themselves. I'm not saying they are, but thinking it's Aritzia 2.0, and very well could be kind of thing. But what Aritzia has accomplished is quite impressive on their own. So it's a tough act to follow for them. That's for sure.
Yeah, no, definitely. Yeah, okay. No, that's good.
Oh, no positions in any of those companies that I mentioned.
Okay, awesome. And then on the noteworthy questions, I guess I'll start with my two. And then did you also have two here, or was that? Yeah, you do. Okay. Okay. All right. So I've pulled mine up. And so basically, this is a question from a member, Alexandra, and she mentions, 5i has been a terrific resource for many things, including recommendations for great stocks that I would have never owned otherwise, but I now have too many favorites and need to reduce the number of equities in each of these three sectors: financial, industrial, and tech. I won't read the full question, but, essentially our answer, we kind of say, one high level trick to help guide an investor on which names to remove can be to act as though you were going to purchase a stock as a brand new position. Would you buy it today? If the answer is no, it's probably a good sign that it's a sell candidate. And then also, if positions are small in a portfolio, it often means that the investor does not have a whole lot of conviction on the name, and it also won't be contributing much to the portfolio, making it an easy name to remove as well. And so I like this, this question and answer for kind of the, a mental framework and model for how to, conduct a bit of like portfolio management. And so a lot of those kind of resonate with me in terms of, there's this one, I think it was you that actually mentioned this to me a couple of years ago or more. And it was essentially if a position's nagging at someone, like if it's in the back of your head and you want to sell it and it's just something that's been lagging for a long time, fundamentals are kind of weakening and you're wondering every day if you should sell it. It's usually that's a good indicator that you should sell it or that it's a good idea to sell it. Cause usually like that gut intuition can sometimes be like fully correct.
Yeah. But it's not even gut, right? Because there's a reason all of those, call it internal feelings or whatever, are firing because you've picked up on certain issues at the company.
Right.
Part of it might just be stock momentum. Part of it might be, they took on a bunch of debt and that sort of. So you have all these kind of smaller events that maybe aren't quite, on their own, something to trigger you to make a decision, but they all sort of start combining and start weighing on your mind a little bit. And that's why that nags on you. Right. And so,
Right.
Yeah, I always find just oftentimes once when you start questioning it, it's often just best to remove it from the portfolio. And if if something changes, then you always come back to it. I think a lot of people forget that when you sell something, it's like it's like the classic, you don't need to marry the stocks, right?
Yeah.
You can sell it and hey, maybe if you don't make the perfect call and it goes up another 10% from when you sell it, you can buy it back there and hopefully there's plenty more runway for the stock anyways, right? And
it's not like the stock remembers where you sold it or bought it.
Yeah, but it's like it's probably nagging at you because things are going wrong on it, right? No, obviously, like always, you got to do your due diligence. Just because it's down and it's underperforming is not in itself a reason to sell, but it's also down for a reason typically.
Yeah,
too,
that's
right. Like whether or not
know
it, there's something else going on in the market, probably leading to the weakness that you need to get to the bottom of. So
no, it's a great point because there is like this internal conflict where an investor might be emotionally attached to the stock. They hold it so they don't want to sell it. They want to feel like they were correct on it. Mm-hmm. But then if internally you're thinking, there are these fundamental issues, then that can like be a conflict with the other side of your brain basically. And so when you really just get down to the logic and look at it, sometimes it just makes sense to sell it, move on to something else. And that opportunity cost, like, sometimes you can sell a stock that's been weighing down your portfolio and then all of a sudden reallocate to something else that goes up 10 to 20% in the next month or something. And you start to claw back those losses.
Such a good point too, because oftentimes it will, since you're focusing on the losing stock, your attention's diverted and you're missing, that other stock in your portfolio that maybe it's a smaller position, but it's doing really well. And you actually should be adding to that one, right? But you're not because you're so anxious or focused on this, the one that's not doing what you want it to do.
No, for sure. So it's a good little piece on portfolio management. And then the second one, this is, a member asks, Stephen asks, given Trump's latest musing about credit card companies capping their interest, how negatively will that affect PRL, which is Propel, and its business plan? And we respond that it's possible it'll help. If banks start withdrawing credit, then PRL and others could see increased business. So I like this response, really for the mantra that like, there's always, even when headlines and news can seem dark or catastrophic, there's always an opportunity somewhere. So like, even when, something might be weighing down one person's portfolio or a piece of it, or, opportunities out there, really like negative headlines can also present opportunities in other areas. So it's kind of the thesis that like there's always an opportunity somewhere. So it's important to just like look for those opportunities. Being an optimist wins. So yeah. All right. So those are my two.
Okay.
Yeah.
Mine's all just, I've kind of consolidated a bunch of types of questions we got around the Supreme Court ruling on validity of tariffs in
Right.
the U.S. So, I think the first answer here is no one knows what the ruling is going to be, and no one really knows what the market reaction is going to be. But I think you can kind of, it's going to be interesting to see how markets take it in stride. On one hand, I think markets uh, could do well if they remove these tariffs, but on the other hand, the administration's already said that we already have kind of the backup tariffs ready to go, kind of thing, right?
Right.
So
Yeah.
so remove them, maybe that's good, but then they're gonna unleash more different tariffs, but more tariffs as well. So there's kind of going to be a bit of an offset there. And to some degree, it might be the devil you know is better than the devil you don't know here, right? So at this stage, markets have sort of accepted them. They've taken the tariffs in stride. Companies have, to some degree, adjusted, and then you're going to have another event where things kind of it creates a bit of a ripple in the markets, and so that might just create more volatility. So if they're viewed not valid, I think net it's probably going to be better for the markets. But I don't think I wouldn't necessarily expect some big jump in markets or anything like that from it
Yeah.
as well. Also, I think to some degree there might have been a bit of a run up already in markets in the expectation that they're going to rule against these tariffs as well. So you could have a scenario where it's priced into some degree. They view them as not valid, and then markets maybe actually pull back a little bit, right? Because it's already been sell the news type of scenario. So
Yeah.
I think there's a lot of ways it could play out. I think the one thing, if I had to kind of make a prediction on anything on the tariffs, is that they won't make them pay it back. So even if they view them not
Right.
valid,
Right.
I think it's going to be such a quagmire to try to figure that out, like how to pay them back, what the process is, all that kind of stuff. That it's just like nobody wants to deal with that, right? So and they'll just call it like whatever was received as of date X, it is what it is, and we're going to move on from this kind of thing. So
Yeah, no, I agree. Yeah, and you can see on Polymarket too and other prediction markets, like it seems like the odds are pretty low that they're gonna like uphold the tariffs and they're gonna like rule against them. The odds are pretty high for that. And then, yeah, we've also seen like every morning that they're supposed to announce some sort of ruling, the market's kind of heavy, and then
Mhm.
they delay it, and then the market's kind of like, lift off a little bit
Goes
higher.
back to normal.
So
Yeah.
even though that creates more uncertainty, which the market typically doesn't like, it seems like the market is actually just okay with the status quo of not knowing where those things land and just kind of knowing how to navigate these tariffs as the market has been for the past year or so.
Yeah. No, that's fair.
Yeah.
But I do think if you're looking for sort of for specific sectors that might do well, or spaces, probably the resources and commodity sectors from a Canadian perspective are probably going to be the main winners from any, call it, positive news on the tariff front. So
Yeah. Yeah. It's totally fair.
but again, I go back to the fact that there has been some sniffing out of these potentially getting viewed as invalid anyways. So and the next one was you did a special report at 5i for regarding AI, and I just want to kind of highlight that. I think it's worth talking about. It was really well received, and in the report, it sort of just highlights all the different, call it, niches within AI and all of the companies that operate within those niches. So I thought it was a really good report. Just if somebody wants kind of that high level, maybe even somewhat granular view on all the different companies operating in AI and how to get exposure to different types of areas, if you're interested. So, and given that I think we're still pretty, there's been a lot of talk around AI and the trends, but I think we're still pretty early innings on this whole build out and the trend. I mean, talking about IPOs, there's been a couple AI specific IPOs, but I mean, Anthropic, which is one of the big players, is not public yet. Obviously, OpenAI is not. So there's still a lot of interesting companies coming into the fore for in terms of public markets. So Yeah, it was an interesting report though. Maybe we can put the download link or something like that in
Yeah.
the comments or something for this video too. But
Yeah, for sure. Yeah, we'll drop that in the details and the description for the show notes, and then yeah, thanks for that. Yeah, it's essentially it's kind of looking at the AI compute stack and the whole layer, like all the layers of the AI compute stack, and essentially it was I was kind of curious on, like, we've been hearing about memory stocks and GPU stocks, and then there's even you know the power generation, energy supply, and so I started to realize, like, there's all these different, like, niches, like you said, towards this whole data center infrastructure build out, all the way from like power cooling and things like that. And so I really wanted to like compartmentalize them and segregate them so that it's really clear, like, which US and Canadian stocks benefit from each segment, and then how to play those segments and like why they're going to be important over the long term. For example, right now we're hearing a lot about memory stocks, the memory, kind of bottleneck. And so this talks about a few, memory stocks, and kind of talks about like why memory is important for AI workloads. So yeah, that's kind of a general gist of how that report works. And yeah,
I think it's one
I'll
of the
drop that in the notes.
maybe yes, one of the almost scary things about it too is you see how much it all touches
Yeah,
as
that's
well,
right.
right?
Yeah.
So you kind of want this whole AI build out and the AI theme to work out because it is a contributor to broad
Yeah.
economic growth right now, right? So it's probably a good thing if it does kind of work. So
That's fair. Yeah. It's like all the way from industrials, materials, software, internet stocks. It's pretty crazy. Yeah. So yeah, no, definitely I'll drop that in the show notes, and then go check it out. Okay, so I'll talk about a recent 5i report that we did. So this is on a well-known company. Lots of people know about it. Lots of people probably use their services. So it's Enbridge, ticker is ENB. And essentially, Enbridge is one of North America's largest energy infrastructure companies, known for owning and operating an expansive network of oil and natural gas pipelines, plus utility assets. Investors can think of it, instead of just being a commodity producer, it's more of a toll collector, with most of its cash flow coming from long-term fee-based contracts that are mostly insulated from oil and gas price swings. This helps support its nice dividend of about 6%. And most interestingly to me is that in 2023 to 2024, Enbridge's share price kind of lagged the broader market, especially as we saw like, mega cap tech names, roar higher, and like AI, the whole AI theme kind of hit the ground there. And so in this time, I kind of noticed that investors were frustrated by its heavy capex spending and dilution, and there were some perceptions that its upside was capped because its revenue was tied to these fixed tolls. And so I wanted to share essentially what happened price-wise in that time period. So this is a graph of Enbridge's share price from 2004 all the way until basically 2023. And so we can see that 2004 up until 2015, the share price just went on an absolute run straight up and to the right. And then it kind of flatlined for a little bit. Had a nice little bump into, I think, 2021 there. And then it kind of just languished for a little bit. And I think investors were getting frustrated because it was flat for a while. Like, yes, it was paying a nice yield of 6%, but price was kind of flat. And people started to almost like capitulate on the name, mentally, but also with their portfolios. And then I just want to highlight what happened, after that period. So essentially, we saw it languish for a while. And then since 2024 to basically today, 2 years, it went up about 57% over that time period, which makes about a 26% CAGR in those 2 years. So it's kind of a lesson that like the most frustrating price action, especially on a high quality stock, can sometimes just be, a matter of waiting it out, being patient, and just waiting for kind of the fundamentals and everything else to align. Because, when investors own a high quality stock. They know why they own it. They know why it's a good company, but the price action is just kind of lagging. It's not always a good idea just to sell it out of, fear that it's lagging. And that's kind of, exhibit A of how, selling too early can miss out on that 57% gain in 2 years. So
That's why focusing on the fundamentals is just so helpful with investing, right? Like, because maybe a stock's flat for a year or a couple of years, or even going down, but you can look into the fundamentals. You say, well, they're growing their earnings, they're growing their revenues, whatever. Things are moving in the right direction. Nothing bad is happening, but the shares are just getting cheaper, right? And so it's, again, you don't necessarily have to add to the names that are underperforming, but you can still hold them for as long as the fundamentals are moving in the right direction, because eventually the market usually wakes up to what's going on and rewards the companies that they're doing things the right way. One of the nice things about Enbridge, just in terms of their stability and the dividend they pay and everything, they've been around for forever, pretty much, right? So you can have a bit of confidence that here's a company that knows how to operate through whatever type of cycle we're in, and just kind of that nice long-term compounding type of return profile for it.
Nice, yeah, I like it. All right, cool.
And no positions.
Yeah, no positions. Yeah. Yep. No positions. And and then I think you had a piece on our 26 themes.
Yeah, just quickly, because it's kind of it's late at the end of January now, but kind of some three kind of main themes that I'm looking at are the one obvious one, I guess, is AI. I think it's a kind of a 2.0 version. There was a bit of maybe early last year, a bit high interest in AI in the kind of last quarter of 2025. I think there are a lot of fears kind of arose around the AI space and investment in the space, which I think was kind of unfounded. And I think we're already starting to see that is the case. But so I think AI is going to have a good AI related stocks are going to have a good year this year. And there's a lot more kind of to come in that space. And if you kind of missed it, a year or two ago, I think you sort of have a bit of an opportunity to get some exposure to the space when it's not particularly frothy or anything like that at this point.
Yeah.
Next one is robotics. I think robotics is going to have a bit of a chat. Now, this might not be a 2026 story, but I think over the next 3 years, robotics is going to have a bit of a ChatGPT type of moment where all of a sudden the idea of having usable, helpful robots in your home, whatever it is, doesn't have to be humanoid, but just helpful robots, is going to start to proliferate. It's already, the humanoids are already becoming somewhat affordable for a kind of beta type of leading edge type of technology. So that's sort of changed. I think AI itself has really solved a lot of problems for robots in terms of how they reason with their environment and their physical environments. And I think you also have a lot of pull forward with the data center build out as well. Obviously, everyone has robots in their home processing things every minute of the day or whatever it is. You're going to need a lot of computing power to help support that. And so I think this current investment in the AI theme is sort of pulling forward some of that ability to support what's going to be needed for robotics to proliferate as well. So, and I think if you listen to some earnings calls from NVIDIA and Jensen, he's sort of has not even hinted at, or like it's a secret like that, but he's talked about like how he's quite optimistic on developments in robotics over the next couple of years, kind of thing. So I think it's going to be an interesting space, and that'll be one of those things that it'll start moving probably before everybody knows that it's going to be a big thing, so to speak. Right. So
it's truly a wild space. Just looking at some of these robots and learning like how they operate, that they can work all day. Once their battery is getting low, they send themselves back to their own charger. Like they charge themselves and then they go back to work. Just the thought of that and the different use cases that can bring over the years is like, it's pretty mind boggling, to be honest. So
and it's, I think part of the problem on the robotics side of things, people think humanoid robots, right? And maybe not those become a thing in our houses. I'm 50-50 on how that's going to develop, but every type of appliance you have could become a robot. And it's like lawnmowers, right? That could become a robot of some sort. And now you don't have to mow your lawn. You'd probably be willing to pay a premium just so all you have to do is push a start button on your phone and it goes out and just cuts your lawn for you once a week or whatever. I don't know what people are willing to pay for that, but they're probably willing to pay a bit more than a lawnmower to do that, right? Like a premium kind of thing. Snow for us in Canada, everybody's shoveling out right now, I think. So snow blowers, right? Getting a robotic snow blower. I don't even have to leave my house. Maybe I just have to hit the garage button, open the garage, and my robot snow blower goes out and cleans up my my driveway. I think people pay a lot of money for that right now, kind of thing, right? So I think there's a lot of interesting use cases for robotics that aren't just this idea of a humanoid doing your dishes or whatever it is, kind of thing. And that's getting missed, I think, in a lot of the conversation. So, and then I'm going to go total other side of the risk spectrum here, and it's consumer staples. I think more so on the Canadian staples space actually done pretty good over the last little bit. But a lot of U.S. staples names are trading at maybe high single digit multiples, low teen earnings multiples, and they should be. I mean, it's been not a great scenario for them. They took too much price. They don't have a lot of growth levers they can pull, and consumer tastes are changing to some degree on some kind of more traditional staples names. But regardless, they're still staples. They still probably have their general growth rate will be to the kind of GDP growth type of thing. So I think, if you're looking at these names at low teens multiples with 5%-ish dividend yields, and if they're growing the bottom line organically at 3%, and then they can buy back another 2 or 3% of shares a year or something, the math starts to work on them, I think, over a long term period. Do they is 2026 going to be their banner year? Who knows, kind of thing. But I think it's in terms of kind of getting a good entry price in them, I think there's some interesting spots to pick away at in the consumer staples space.
Nice. Yeah, that sounds good. And that's we're kind of talking like the Coca-Colas, Procter, Colgate, or are you going like more grocery store?
Those, I think you just got to kind of pick, look through the space. But like Campbell's. I mean, again, I don't know if Campbell's is necessarily the one, so to speak. But that's a great example of Kraft Heinz, and that one, because I know Berkshire is looking at exiting their position in Kraft Heinz, so maybe you have an extra kind of weight on those shares right now as well. And so again, do they go up 20% this year? No one really knows, but I think from in 5 years, over a 5-year holding period at the valuations a lot of these names are at, I think you could do okay with them. So
nice. Yeah, that's good. Yeah, it's a nice barbell against your other two themes too, I guess. Yeah. No, that's solid. Okay, I like it. Awesome. Okay, and then I guess I won't add much on the themes. I think those are solid themes. I agree with them, and I particularly like robotics. I think we're seeing some names do really well there. It is kind of under the radar to a degree. So yeah, I think those names can do really well, especially like long term. I mean, that secular theme really isn't going away. So yeah, I like it. Okay, cool. And then finally, we're going to be doing piece of investor education. So I have a graph pulled up here. Ryan, I know you can't see it, but essentially what I did is I overlaid the NASDAQ 100's price, cumulative price appreciation from 1990 to 2000, overlaid with kind of like the advent of AI and the NASDAQ. So basically NASDAQ 100 from 2023 to today. And what the chart looks like is pretty ridiculous. I mean, the .com bubble really just goes parabolic. It goes up and to the right, especially in that final year. Whereas AI 2023, NASDAQ 100, we're just kind of like, baby steps right now. It's a little bit higher than what happened in .com, but really not even close to like blow off top type of mania. But I think when you talk to a lot of investors, like there's this kind of thinking of like, oh, the NASDAQ has only gone up over the last few years and it's been getting a little bit ahead of its skis and things like that. But really when you overlay it against, past analogs, it's not even like in the same wheelhouse at all. Basically, it's not even really comparable on a, price appreciation basis. And then like another interesting fact is, I think 1999 to 2000, I'm pretty sure the NASDAQ 100 just about doubled in that 1 year, which I'm not sure like many people know, but a lot of people think, oh, we're in like 1999, 1998, maybe for AI. But really, I mean, I haven't seen the NASDAQ do a double in the last year or so. So
and it's been strong. It's had a good couple
it's
of
been
years,
strong.
that's for sure, but no, it has not doubled.
Yeah. So I just kind of wanted to like overlay those two just to kind of quell investors' fears about this being somewhat similar to like the end of the .com, or if AI is in a bubble currently. Because not only on valuation side, that's not really the case, but also price appreciation. So far, this isn't really anything like the .com. So
I mean, the skepticism is just so high in the space, right? Which is a good thing. I mean, it's keeping everything in check.
That's right.
Great.
Yeah.
But yeah, it's people just don't want it to be a thing, and maybe they'll be right, but I think it feels pretty real to me so far.
Yeah.
Everything that's going on in AI.
Yeah.
Interesting too. So when you look at a historical valuation chart of more so S&P 500, but when you go back, call it to pre-advent of the pre-proliferation of the internet, valuation on the S&P 500 traded kind of cheap on a historical basis. That 15 times that people like to quote all the time.
That's right. Yeah.
And then post-internet, you saw valuations take a step up, something closer to that 18 to 20 times range.
Yeah.
And so, and that's one of my big frustrations over time is people, when they do a really long-term average valuation calculation, say markets should be trading at 15 times earnings. But no, the world has changed. The companies in the index have changed. They have higher margins, higher valuations, and they should have higher valuation. So point being is that you've had this step up in valuation after the internet, and internet companies sort of really started to become a bigger part of the index. We're currently sitting at higher valuations already for the S&P 500 and certainly the NASDAQ. But it'll be interesting to see, over 5 or 10 years now, if that really what's happening is this is just another, call it long-term valuation step up in the markets, because now you have the AI step up. So you have higher margins because maybe it's cost savings. Maybe you just have new companies come in that have a totally different, better margin profile, stickier revenue, whatever it is. I mean, maybe not, but it's, I think it's just kind of I don't know, something you said sort of tweaked that idea in my head, but it'll be interesting to see that, maybe, yes, valuations are high right now, but maybe there's a justification because there's a bit of a transformation going on in how companies do business and how their margin profiles look with the help of AI down the road. So.
Yeah, I fully agree. And interestingly enough, like this is another kind of fact that's kind of alongside those lines, though, is, in 2000, Cisco peaked at Cisco, the internet, the tech company, peaked around 350 times forward earnings. But if you kind of use like NVIDIA today as being like, let's call it the bellwether, like AI stock, it's at like 25 times forward earnings. So it's kind of like apples and oranges so far for like AI bubble sort of talk. But regardless, like you said, skepticism's healthy. So, I mean, it's a good sign that I think we're still pretty early here. Yeah.
Fair.
Yeah. So yeah, that's my little ramble, I guess. But anything else that you wanted to add for today?
No, I think that covers everything I had to talk about.
Okay, nice. Yeah. Solid first episode for the year, and hopefully the sound issues are resolved now. So that's all that we have for today. We hope you enjoyed this episode of our podcast and learned something new about the Canadian and US markets. If you want access to more exclusive content and insights, don't forget to visit our website at 5iresearch.ca and sign up for a free trial if you haven't already. You can find the link in the show notes below. And if you like this episode, please give us a thumbs up and subscribe to our channel for more updates. Thank you for listening, and we'll see you next time.
Thanks.